Pretty interesting week. I don't think anyone should be, too surprised to see that I started off the newsletter just saying it's been a volatile week. The biggest event this week was yesterday's September CPI numbers being released. So, in case anyone somehow managed to miss it, the year-over-year headline number was 8.2%, which came in 10 basis points above the median analyst estimate of 8.1%. Core CPI also came in above analyst estimates at 6.6%. And so essentially, year over year headline was down slightly from August's 8.26%, which maybe appears bullish at first. But I think the thing to note is that CPI inflation is not declining nearly as much as many are expecting or were expecting. On a month over month basis, CPI inflation rose by 0.4%, which doubled the analyst estimate of 0.2%. And essentially, what this is saying is that the current Fed policy, which is to remove liquidity from the markets in the form of QT and to aggressively raise interest rates, should be lowering demand enough to lower prices. But unfortunately, that's clearly not the case. And I think in a more textbook macro environment, that would be the case. But 2022 has been anything but textbook. So from there, I kind of go into the specific components of CPI and breaking down, what individual pieces of CPI are driving these higher prices, or I should say, prices that are not declining as much as many were expecting. So in the chart that I include in the newsletter, we look at energy, food, and shelter. So what you can see is that energy prices have fallen significantly in the last few months, but it's being offset by other components of CPI, which is why we're not seeing CPI decline as drastically as energy prices are. So food and shelter are some of those pieces that a lot of analysts like to look at. And what we're seeing is that food prices are up 11.2% year over year. So I don't think that should be too much of a shock to anyone if you've been to the grocery store. And shelter prices are up 6.6% year over year, in line with headline CPI. So and I think that just kind of illustrates, exactly why we're not seeing CPI decline as much as a lot of people thought we would. So from there, we kind of look at how is the market reacting to this news in terms of what is the Fed going to do in the remainder of the year. So we look at the Fed Watch tool, which is provided by CME Group, which basically looks at Fed futures data to determine what is the market expecting from the Fed for the remainder of the year. So there's no October meeting, but there is a meeting in November and December. So last CPI report, or I should say last FOMC meeting, we were expecting the terminal rate, or the rate at the end of the year, to be 4.5%. That's the upper limit of the target Fed funds rate. So now, after this CPI report, where prices are not falling to the extent that many people were hoping or expecting, that target, or that terminal rate, is being moved up. So now we're expecting to see, or I should say the market is expecting to see, a 4.75% Fed funds rate at the end of the year. So before, people were pricing in, or I should say market participants were pricing in, a 75 basis point hike in November, and then bumping that down to a 50% hike in December. And then yesterday, after that report, it's now moved up to 75 basis points in both November and December. So that would put the Fed funds rate at 4.75%, as I mentioned, and that's the largest value, or it would be the largest value since September of 2007. So on the production side, moving away from the consumer side with CPI, we're looking at PPI, which is the Producer Price Index, which was also up in September above estimates, and it rose to 8.5%, which was down from 8.7% in August. But on a month-over-month basis, PPI rose by 0.4% also, same as CPI, which was above that analyst estimate of 0.2% as well. So, it's I think the thing to note is that PPI tends to be a leading indicator of CPI, right? Because when the cost for producers is rising, eventually they're going to have to increase their prices for consumers, their sell prices, in order to retain those profit margins. Or PPI tends to lead CPI. So I think over the next couple of months, I think PPI is probably going to be the indicator to watch as a sign of potentially higher CPI numbers to come. So moving on from PPI, CPI, Allianz, which is the 9th largest asset manager in the world, they're based out of Germany. They released their annual global wealth report. And what that looks at is, or I should say what that showed, is that household wealth across the world is on track to decline over 2% in 2022, which may not sound like a lot, 2%, but that's a massive amount of money. And Alliance wrote in the report that, quote, 2022 marks a turning point. And what they meant by that is that it's going to be the first significant destruction of global wealth that the world has seen since the great financial crisis of 2008, which I thought was pretty interesting. And we can see this decline in global household wealth here in the US because we're seeing this steep decline in the expected level of spending for next year from US households. So the New York Fed also released a report this week they called the Survey of Consumer Expectations. And there's an interesting quote from there. Yeah, I'll read it. It says, median household spending growth expectations fell sharply to 6% from 7.8% in August. And they're referring to September. Its steepest 1 month decline since the series inception in June of 2013, and its lowest reading since January of this year. This decline was broad-based across demographic groups. So what they're saying is across all demographic groups, we're seeing that Americans are clearly expecting to spend less money in 2023. So to me, what this says is that this expectation of recession coming and this higher than usual expectation of potential job loss in 2013 means that Americans are saying, hey, I need to sideline some capital in case stuff goes bad or I lose my job or whatever. So I think I just thought that was pretty interesting and worth mentioning in the newsletter. On the housing front, the U.S. average 30-year fixed mortgage rate is approaching 7% for the first time since 2002. So now mortgage rates are above what they were in 2006 and 2007. So, and I also mentioned that there's a lot of news articles saying that mortgage rates have surpassed 7%, and that's looking at third-party data providers. Personally, I prefer to use Freddie Mac numbers, and for those of you who aren't homeowners or aren't aware what Freddie Mac is. I explained it in the newsletter. I'm not really going to go over it here, but essentially, I just believe that looking at a government-sponsored corporation that has a massive hand in the mortgage secondary market is probably more accurate than third-party data providers. But that being said, whether the 30-year average mortgage rate is 7.2% or 6.9% or whatever is pretty arbitrary, I think, because the effect is the same on the markets, right? You're going to see a decline in demand for new mortgage signings and then lower home prices to come. And I think we're already, or I don't think, I know we're already starting to see that happening. So, based off all that data that I've just, explained, we've mostly seen a sell-off this week from the fixed income and equity markets. So the U.S. 10-year Treasury cracked above 4% yield yesterday for the first time since 2010. And 4% has been a pretty big level for the 10-year. It's been an area where investors are looking to lock in yields, so it turns into a resistance level for yields or a support level for bond prices. So Thursday, it looked like we might crack above that. Ultimately, we got this reversal, which ushered in that big reversal that we saw from the stock indexes and Bitcoin as well. And I think the base case is kind of similar in all those markets in that there was this fear of high CPI or higher than expected CPI last week, which kind of caused this sell-off into the CPI announcement. And then it ended up turning into a sell the rumor, buy the news type event yesterday, or at least I believe. And then today, the 10-year yield is back above 4%, currently sitting at about 1 or 2 basis points above 4%. In the stock indexes, I look at the NASDAQ in this newsletter. Yesterday, we gapped down 2.75% roughly on the CPI announcement. But if you were watching the market yesterday, essentially straight off the open, we just bounced and we ultimately reversed higher. And the NASDAQ ended up closing 2.23%, up to 2.23% on the day, which was an extremely significant reversal. And we saw these high volume upside reversals in large cap stocks like Apple, Tesla, Microsoft, Amazon, etc., which could lead me to believe that it could have ushered in a potentially significant counter trend rally. But I think based off the trend of the market, it's still most likely that we're going to see lower prices. I think it's worth noting that we're seeing this yesterday we saw this large bounce alongside a pretty grim outlook from the market on the Fed's position. And as I've mentioned in the newsletter a lot, if you're a reader of the newsletter, you've probably heard this a lot of times, and it's that the market tends to bottom with the worst news. And I think yesterday maybe was that potentially, but in these big general market corrections or bear markets, it's really common to see these aggressive moves to the upside when you're in really oversold conditions, which is what we were at the open yesterday. So I think yesterday's price action was certainly constructive. I think there's no debate there, but I think it's much too early to determine is this going to be a multi-week rally or is the market going to ignore it? Today we're down 2.5% on the Nasdaq, and I think still, even based off today's price action, it's too early to say is the market going to bounce from here or are we reversing lower? And I think it would kind of be disingenuous of me to try to make a prediction because I don't know, and anyone on Twitter that tells you they know is probably incorrect. I also have my crypto exposed equity section as always. It's kind of the same thing as what I just explained with the equity indexes. Obviously, when you have equities and Bitcoin bouncing or reversing, you're going to see the same thing in the crypto exposed equity group. I mentioned about 7 names that I think, from a technical perspective, had the most impressive bounces yesterday. Not that this is a advertisement to go out and buy those stocks. I just think it's worth noting in looking at relative strength, which is one of the more important things to be doing in a bear market. I also explained the concept of overhead supply. So if you're not aware what that is, also I highly recommend going out and checking out that section. Also, just a little bit about Bitcoin TA. It's essentially in the same boat as the equities or technical analysis as TA. So yesterday we barely undercut those lows from September 21st, and it kind of ushered in this what we call a undercut in reverse rally, which is price pattern that we see. It's essentially someone selling Bitcoin down to a certain level to undercut a key support level, which blows out tons of stop losses. I bet a bunch of people have stop losses placed at that September 21st low, and then they're just going to accumulate all those satoshis and reverse price back higher, which is pretty much what we saw yesterday. And then today we're kind of seeing Bitcoin run into some resistance again around this large declining trend line, overhead trend line. So if you're interested in Bitcoin TA, go check that out. But that about sums up what I wrote for this week. Mitch, if you have any questions, happy to answer. If anyone has questions in the audience, shoot me a DM. I'm happy to answer as well.
That was a great breakdown, Blake. Is this stagflation? Because the economy definitely is showing signs that it's slowing down, but inflation is not going anywhere.
Yeah, I think we're arguably in a recession at the moment, right? And I think if not in a recession, like I would probably agree with what Jamie Dimon had to say this week. It's 6 to 9 months seems like a pretty solid estimate of when we could see a recession. And if that's the case, we're likely going to see stagflation. And I know you're a big safety guy who kind of cracks into those Keynesian models where stagflation just can't exist, which I think is pretty interesting and pretty funny. But we've seen it before in the 20th century, and I think probably we're seeing it again. But I also think that the biggest thing in there was like this whole debate about technical recession versus actual recession, right? There's a government agency that has to declare we're in a recession versus just the 2 quarters of declining GDP. And one of the things that they're looking at to declare an actual recession is unemployment, and we're not really seeing unemployment rise like many were expecting. But I think it's possible that it's coming. We're seeing, we're starting to see layoffs in certain sectors. We're seeing a pretty wide scale hiring freeze kind of across the board, across industries. And that's always step one is you're not going to fire your existing employees before you stop bringing on new ones. So step one is always freeze hiring. And then later down the line, then you might start laying off employees. So I think in the coming 6 to 9 months, maybe. I mean, that's just an estimate, obviously a shot in the dark. I don't know what the timeline is going to be. No one does. But estimate, I think 6 to 9 months makes sense to me. I think we could start to see those layoffs. You could start to see unemployment rising. And that would, signal to, the economics agencies that are declaring recessions that we're likely in one. And that would essentially, certify that we're in a stagflationary environment.
I'm glad you brought up the unemployment because something I've noticed, and maybe I'm just ignorant is there hasn't really been the politicization except for what you said about the when they were arguing, are we in a recession, are we not? But considering the midterms, I would have thought the economic issue would have been politicized more than it is. But if we next year, if unemployment really starts ramping up, and then also gearing up for the 2024 presidential election, which obviously a lot of people pay more attention to that than the midterms. I think the economic issue probably will get a lot more politicized, and I I don't think that's a good thing.
Yeah, I mean, I would agree. Just on a personal level, I think it's starting to get politicized to an extent, right? You saw Biden this week saying that if we enter a recession, it'll be a very slight recession. Like they talk about it a lot. I think kind of both sides want to avoid the issue to an extent because I think they kind of both had a hand in what's going on today. Obviously, not 100% of what's going on is the fault of politicians, but I think policy does did drive the situation we're in today, and I think kind of both sides had a hand in it to an extent. So I think it's interesting to see like both sides kind of want to avoid it to an extent, but yeah, no, I agree with you. Like you would think that this would be at least from people who are trying to go against Biden in midterm or just the left in general in the midterms. You'd think they would be harping on the economy, and they're really not, which I just think is interesting. Not to get into politics here.
Yeah, for sure. And I guess we're just gonna keep having this high inflation unless the energy situation gets under control. So it'll be definitely interesting to see how 2023 goes.
Yeah,
Um,
and like that's what I mentioned in the newsletter too with the CPI component breakdown is that we're seeing energy prices falling at least here in the U.S. I'm only speaking for the U.S. here. Um, we're seeing energy prices falling, but you're not seeing CPI fall to the extent that energy prices are falling, and that's because you're seeing other areas of CPI or other components of CPI continue to rise. Like I mentioned, food prices are up 11.2% year over year.
we can shift gears now and talk about the Bitcoin on chain. So first, the long-term holder realized price and short-term holder realized price. I know we've talked about this in like almost every newsletter, but when these cross, it's extreme value. And the reason for these crossing is short-term holders aging into long-term holders. That's long-term bullish because that's more people from the past bull market that are now, hey, they understand Bitcoin, they're convicted, they see the long-term value proposition. And that brings up the long-term holder cost basis as they age into that cohort. And second, you see long-term holders just continue to stack. These prices, they're obviously a lot higher than the long-term holder cost basis. We have people buying back in 2018, 2015, etc. But they still see the long-term value proposition of Bitcoin and they recognize even 20,000, even if they were buying at 1,000, this is still value because of what Bitcoin's going to do in the long run. Next, when we look at coin days destroyed, and all these charts are in the newsletter. If you click the nested tweet, there's a link there. It's down extremely low. And coin days destroyed is a combination of coins and then how many days since they were last moved. So 10 coins that were moved 10 days ago, that's going to be 100 coin days destroyed when those coins get moved. This being low, it's another sign that long-term holders are not moving their coins around at all. And it's also a sign that transaction activity in general is really low. Two things that you're definitely looking for in the bottom of a bear market. You wouldn't expect long-term holders to be moving their coins, and you would expect minimal transaction activity relatively. Now, of course, the bottom of like transaction activity is always rising through each cycle because Bitcoin's getting adopted more and more people are actually using it as a medium of exchange. But still, relative to the bull market, transaction activity is low. And when you look at the long-term holder supply, again, that confirms that thesis. Over the past 3 months, it's 45 degrees up and to the right. Long-term holders are just adding to their bags. I am one of them personally, not the Blockware account, but Mitchell, myself. Then an interesting metric I saw this week, Checkmate from Glassnode. He made a video about this, and it's something I hadn't looked at before. It's an adjusted version of the percent supply and profit. So when you look at percent supply and profit, just non-adjusted, we're not quite at bear market levels, but you have to think that a lot of the coins, there's Satoshi's coins always going to be in profit. There's lost coins from early in Bitcoin's years always going to be in profit. that's sort of diluting the metric of the percent supply and profit. So when you factor out those coins 7 years or older, that's the benchmark you use. We're at the same level almost of the percent supply and profit. So ignoring the Satoshi's coins and really old coins, we're almost at 30% of the supply and profit. So 70% is at a loss, just about. So that's a lot of blood right now in the market, and that it is congruent with the past bear market. That's not to say history is going to repeat itself, but that's sort of what we're looking at on chain. We're looking at the broad cycles of Bitcoin. Something else I pointed out in the newsletter is ETH is down 22% against Bitcoin since the merge. The the idea there, sort of, that I was thinking is it was going to be a buy the rumor, sell the news, and 1 month later, it appears that that was the case. Something else I noticed is a lot of people, there's varying opinions about the Bitcoin dominance chart. Is it valid? Is it not? But something I decided to look at was the Bitcoin's performance against the top 10 cryptos. So the Bitcoin dominance chart, like whether you're a maxi or you're not a maxi, you have to agree that there's thousands of low market cap, not low market cap, low liquidity coins in the Bitcoin dominance calculation. You can make a coin just on your computer, copy someone else's code, change one thing, issue 1,000 tokens, and trade it for $1. It's gonna have 1,000 market cap, except you do that in the millions. So that dilutes the Bitcoin dominance metric. But by just checking Bitcoin against the top 10 other altcoins, that gives a better perspective of where we are in the Bitcoin versus altcoin cycle. Because during bull markets, altcoins, they're a beta of Bitcoin, so they might go up marginally more during a bull market, but they're going to get toasted during a bear market. So comparing Bitcoin's market cap to the other top 10s now versus the 2018 bear market, we're not as far off from that as you would think by just looking at the Bitcoin dominance. So right now, of the top 10 cryptos by market cap, Bitcoin makes up 57% of that. During the 2018 bear market, at the very bottom date, December 14th, 2018, it was about 66%. But if you were to just look at Bitcoin dominance, you would only see 41%. So you would think, hey, maybe we've got more room to go down to flush out some of these altcoins that may or may not be valid. Next was the futures open interest perpetual contracts volume divided by the market cap. So that just adjusts, obviously, for the price. And what we pointed out last week, but again, it's just going up dramatically this week. So the amount of leverage relative to Bitcoin's price is at an all-time high. So people are, they're getting antsy. We're going to get a move one way or another, and a lot of this leverage is going to get flushed out either in a short squeeze or a liquidation cascade. And when you couple that chart with the Bitcoin volatility index, it's relatively low. And we all know Bitcoin volatile moves are common, so it's not going to stay unvolatile for very, very long. And this does seem to be gaining a little bit of upwards momentum, the volatility index. So couple that with the excessive amount of leverage, somebody's going to get wrecked. I personally am not taking any long or short exposure. It's just you can't really predict the short-term moves, as we saw with the candle yesterday with Bitcoin and in the stock market. It was just a ridiculous candle once the CPI was announced. Went straight down, but then afterwards it was a huge green day. So, and they say Bitcoin's volatile. That happened in the stock market too. I digress. But just the way the market is right now, and Blake, you hit it on the head earlier. Like, this has not been like a standard year. Like nothing you would expect has been normal about this market. So for that reason, I don't recommend taking leverage. And Joe's not here, so I also covered the mining section. There was a 13.5% difficulty upwards adjustment. That's crazy. I mean, obviously it's to be expected. Last week we hit hash rate all-time high. And the reason for this, new generation machines coming online, XP, and then the WhatsMiner new machine, that's going to marginally increase the network hash rate, the fewer power curtailments as we get into the autumn months. I'm curious to see if, as winter comes, if we'll have the inverse, super cold, people running their heater, so people might, miners might have to turn their machines off. We'll see if that comes into play. And then, of course, there was the miner capitulation this summer. those machines have found new homes in more efficient and liquid miners, and they have been plugged back in. And this week on the podcast, we had Bob Burnett, no relation to Joe, but he is also in the Bitcoin mining industry. And Joe and Bob discuss there's three types of Bitcoin miners. There's the mice, which are like you're running a machine in your garage, or that guy in Guatemala who's running it off of vegetable oil. They're hard to find. You could kill one, and 10 more are going to pop up. And this is in regards to like Bitcoin's decentralization and security. There's the elephants, super massive, riot size facilities. These could possibly be shut down. And his example, if the Hurricane Ian comes and hits one of these facilities, you're getting screwed. But if you're a wild horse, as he says, which smaller operation, bigger than the mice, but smaller than the elephant, you're mobile and you still have enough hash rate. Should something happen to a bunch of elephants at once, the wild horses can carry the load. He explains it way better than I do. It's his thesis. So definitely go check out that episode of the podcast on the Blockware YouTube channel. Blake, do you have any comments?
No, I think that was great. I just have a question. You said roughly 30% of supplies and profit. Is that maybe I just missed it? Is that in line with bottom bear market levels? Is that still a little high? What was the case there?
So that's the adjusted version, excluding coins that haven't been moved in 7 or more years. So
Got
that's,
it.
yeah. The actual number is right around 52% is in profit. But when you adjust and take out all those really old coins that if they haven't moved in 7 years, they're probably not going to be moved. Definitely not now at like a local bottom. So that adjusting for it, it's about 30%, which is in line with the previous bear market. But the unadjusted version is not. So that's why we're looking at the adjusted.
Got you. That's interesting. Because I'm more of a more versed in the traditional finance world, right? Like I'm a stock trader and macro analyst. I like to look at anchored volume weighted average price, which is a technical indicator on charts, which basically allows you to pick a point on the chart to anchor your indicator from, and then it'll tell you, what's the volume weighted average price that Bitcoin's transacted at since then, right? So like a moving average is just a straight average of the closing prices, which doesn't take into account, excuse me, doesn't take into account how much volume was traded, how many coins were traded at each price level. But anchored volume weighted average price, or just VWAP, looks at, based on the volume, what is that, what is the actual average. So like the one I'd like to look at, and I included it in the Bitcoin TA section this week. It includes the AVWAP based on the June 18th low. I think it's the 18th, right? Yeah, 18th lows. And we're slightly underwater there. So on average, the average Joe is or I'm sorry, yeah, price is under it. So technically, people are still slightly in profit, but it's funny to see, or I'd say it's really interesting to see how that turns into a resistance level and a support level. It's happened like 3 or 4 times now in the last few months, where it's like people are defending their cost basis, which I think is interesting, and it's different than like an on-chain metric because it's showing you, what are actual people doing, and a lot of it's just traders and institutions and algorithms. But it's really interesting to see, how people are defending their cost basis, or just around these levels. That's kind of a sidebar, not really related to what's going on in the long-term situation of Bitcoin, which you touched on, I think, in a really clear way.
Thank you. Yeah, and it's definitely valuable to look at those short-term behaviors. So that's sort of realized price. It definitely gives the long-term view, but it also in the short term it can act as resistance or support because there is the huge mental side of someone's cost basis acting as support or resistance, especially like the market's cost basis in aggregate.
Yeah, 100%. Do you have any other comments or things you want to share?
That's all for me. Definitely go check out this week's podcast because I don't know how well I explained Bob's thesis, but Bob and Joe really hit it off in that episode. If you're interested in Bitcoin mining, definitely worth giving it a listen. If you missed this, it'll be up on YouTube. And it's also recorded on Twitter. So thank you everybody for coming in. We'll be back next week again, And Joe will be with us next week. We'll have another fire newsletter. So thank you, everybody.
Yeah, have a great weekend, everyone.